So today we're going to have an interesting conversation. We're going to talk about boring stocks. Not necessarily boring returns, but certainly they come under the category of boring stocks. Maybe don't own them, they don't do anything. When realistically, some of these can be secret winners that actually do really well and you don't actually realise. And the first one we're going to talk about is B&M in particular. Because I made a couple of videos on B&M, and you can see one here that was about 3 months ago saying I'm starting to buy B&M stock heavy at the moment, and this has been a little bit of a winner. I mean, today it's up 1.27%. In the last 5 days, it's up 12%. In the last month, it's up 24%. And I would say that this quite often will come under the category of being a boring stock. Nobody wants to get excited about B&M. And I remember posting these videos on B&M, and there was a lot of negativity out there. There wasn't a lot of people that were like, yeah, I want to buy B&M at the moment. Nobody wanted to really buy it, and yet we're seeing a stock like this is up 24% in the last month. A stock like this has majorly outperformed the likes of the S&P 500. If you look at the S&P is down 10% in the last month, but yet a boring stock like B&M is up 24%. Now, the thing is, why do people not want to own a business like B&M, or what was the negativity around B&M? And that was that it's not interesting. It's not a fun stock to own, or it doesn't have the story. And I feel like if that's the point of view, like, it's not about having a story. It might sound interesting telling a good story, but it's about making money in the stock market. And the other thing is that when you do look at B&M, B&M was going through a tough time. The stock kept downtrending for a long time, and people go, oh, it's a dead stock, nobody wants to own that. And people always look at that from the share price point of view and going, you don't own a stock because it's just on a downtrend. Not actually thinking, hold on, is this actually pushing the stock to very interesting levels where you can make a lot of money? And that's what it should have been viewed at, but people just kept, this is what happens when you have a stock that keeps going down. People give up on it. There's like a cycle in the stock market, and eventually there's kind of like, oh, it can't go any lower, and it keeps going lower. Oh, and then people give up on this stock and call it a trash stock, rather than thinking, you know what, it's probably gone a little bit undervalued here. Maybe I should go buy this stock. When it just keeps going cheaper and cheaper and cheaper, then eventually the more it goes from where the stock probably should be valued at, that creates more upside, and then very quickly, boom, you get the rebound. Now, for me, obviously, I didn't exactly catch the bottom, and sometimes, you don't always have to catch the bottom of these stocks, and maybe this is a video as well that is maybe a little bit too early, a little bit too early that, it's only just had a little bit of a bounce up, but I wanted to quite quickly make the point about this while it's fresh on people's heads. Like, you don't have to catch the bottom. For me, I just kept averaging down in the last kind of couple of months, and now I'm up on my position by a good 6%. And as well as that, what people don't really realise is dividend stocks, you're getting a 4.5% dividend yield. Obviously, it was 20% lower, so this dividend was actually into the 5% dividend range. If you actually include special dividends on this as well, with a 15p extra special dividend, B&M was actually paying a 10% dividend yield. B&M was 10% dividend yield, and yet the company was down at 7 times earnings. When you're looking at the valuation, it's had a rebound now back up to 9 times earnings, but B&M fell to 7 times earnings. And then you're looking at the historic valuation and what B&M normally trades at, and normally it's around about 2019 times earnings, but I'd say that that's probably going to come down a little bit now because the growth is slowing down slightly. So I'd say that probably B&M. And when you look at other retailers in this space, I think I always started to use the case of like Tesco's and Marks and Spencer's. They're normally about 14 times earnings. So if this company's at 7 times earnings with a 10% dividend yield, higher than Tesco and Marks and Spencer's, profit margins higher than Tesco and Marks and Spencer's, you got to start looking at those as opportunities. But many people didn't look at them as opportunities. People went, I don't want to own B&M. Why do people not want to own B&M? What's the reason why? Is that just because the share price is going lower? And that's certainly the case with a lot of people. People just see the share price going lower and give up on it. They just give up on a stock like B&M. They don't want to own a stock like B&M. They don't want to own a boring stock like B&M. And why is that? Why do people not want to own a stock like B&M? Well, a lot of people go for, have seen probably in the last few months when B&M's been struggling, stocks like, Palantir going absolutely ballistic, stocks like Tesla going up, absolutely ballistic. Even one that I own, Hims and Hers, going absolutely ballistic. But eventually what people realise is that these stocks that go ballistic, these are also the volatile ones. These stocks can very quickly fall as much as what they've gone up, and then very quickly you get to the position where like Hims and Hers is down, 62%. The likes of Tesla is down 52% from its all-time highs. Palantir is down 23% from its all-time highs. And very quickly people realize actually these stocks can actually fall as much as what they go up, and then they think, well, actually these boring stocks maybe that do a nice little 5-10% return a year, pay you that nice 10% dividend yield a year. I'm up on, when you include dividends on B&M, I'm probably up about 15% on B&M for owning it in the last year, which isn't too bad really. But people, when the market is all hot and everybody sees these stocks going up, people go, I don't want a 15% return. I want to chase these likes of these Palantirs, these Teslas, these Hims and Hers that are going up rapid, up 100% in a month's time. That's what I want to buy. And then eventually people realize they get how quickly they drop, and they go, oh, they'll actually, when they actually drop, maybe I don't want to own these exciting companies. Maybe I want the little basic boring companies that don't do anything but actually give you a nice return. And people get kind of sucked into this, this false gains. The exact same thing happened in 2021. People were powering into all these growth stocks, dividend stocks were put on, forgot about, and then all of a sudden people went, actually, you know what? These dividend stocks actually aren't too bad when you get those kind of steady 10, 15, 20% returns. And you don't have to go through these, 50% dip on these stocks. Now, the interesting thing with B&M is actually you could make the case that actually this has had a tough time. If you do zoom out, it has had a bit of an aggressive fall from its all-time highs as well. I would say that the difference between B&M though is that when you look at how low that this has dropped, this company has dropped to levels that it was below in 2022 when it last crashed, and below the COVID times, which is just insane. And when you look at a valuation point of view, you had the opportunity to buy a boring dividend stock at half the valuation what it normally trades at. You had the opportunity to go buy B&M paying a dividend yield more than it has ever paid before. So, these are really interesting opportunities that you can make good returns on. And the argument case is that, when you look at the likes of Palantir, for example, the likes of Tesla, the likes of Hims and Hers, you could argue the case that even though these are down 50%, even historically right now, even though B&M has been ticking on nicely, it's still historically low valued. Where you compare it to someone like a Palantir, even on the drop it's on, is currently trading at 481 times earnings. Something like a Tesla is still trading at 111 times earnings. Something like Hims and Hers is still trading at 48 times earnings, near historic highs. I'd argue the case that Hims and Hers is a little bit cheaper than the bunch, because when you look at Hims and Hers, it's just coming off 95% revenue growth and 2,000% net income. When you look at Tesla, I would say that you argue the case that this has only grown 2%, and something like Palantir is growing 36%. And that valuation is a lot richer than Hims and Hers for the slower the growth. So I'd argue the case that you look at some of these stocks that they've pulled back, and I'd argue the case that if we were to hit I'd say that these could even pull back further, and if we were to hit more of a downturn, these could have a lot more room to go, because they're still crazy historically highly valued, whereas something like B&M is still very historically low valued and yet has been ticking on nicely. And sometimes people forget, because people have got used to these stocks absolutely skyrocketing. The Palantirs of the world, the Teslas of the world skyrocketing. That people think this is normal. I think a few people have kind of looked at the S&P 500 in the last 2 years, and people have seen like the S&P really since 2023. The S&P is up 33%, and people are like, this is normal. People have kind of got used to this and going, I don't want a stock like B&M that maybe does 10% a year on the share price and pays a 10% dividend yield and gets 20% return a year. People go, I don't want them sort of safe, boring stocks. That's not good enough for me, because I've got used to an S&P going up bonkers. I've got used to a Palantir going up absolutely bonkers. And people maybe in the last 2 years, and maybe even new investors, have got used to that and going, why would I want to own a stock like B&M? It's pointless. And it's like, well, this isn't a normal market. This is not something that's sustainable in the long term. And eventually, while this happens, you'll get the reality check. And that started to happen on some of these stock prices. And, you only have to look at the greatest investors of all time. And, you look at someone like Warren Buffett, for example. What's Warren Buffett's annual historic return? His annual historic return is like 20% a year on the over since he's been in the stock market. 20%. Like, known as the best investor of all time, achieved a 20% return a year. That's normal. But people have got used to the S&P going absolutely ballistic over the last few years, and all these other stocks going ballistic over the last few years, because they don't realise that this isn't sustainable. Like the valuation metrics that some of the S&P's expanded to, the valuations that Palantir and Tesla have expanded to the last few years, isn't normal. And eventually that will catch up. And eventually we'll go into a place where a normal return on the S&P 500 is 9-10% a year. You know, when you look at someone like a Warren Buffett, a 19% a year return is normality. That is, you know, that's the greatest investor of all time over a longer period of time. You know, look at Peter Lynch, another one of the greatest investors of all time. He achieved a 29% year over year return, and that is known as an exceptional return, one of the best investors of all time. But people think that this is sustainable, and it's not sustainable. And eventually that'll catch up to people, especially when they see especially these two, when these stock prices do have these reality checks. You know, they will realize that actually, you know, when we actually get into a proper valued market, a fair valued market where stocks should be valued, or when we do have those downturns in the stock market, which, funny enough, you know, so far this year has been one of those, you know, downturns in the stock market, with the S&P down 12% year to date, and from all-time highs down 16%. People realize actually sometimes these boring stocks can be just as good performers as these stocks. And actually, you know, when the times get tough and, you know, these stocks actually have a reality check on the share price and those metric you know, contractions, they can actually be pretty good stocks to own. You know, Card Factory, I've seen for a long time, you know, people been bashing Card Factory. It's up another 3% today. In the last 5 days, it's up another 4.8%. In the last month, up 13%. You know, another sneaky kind of winner. Same again, you add a 6% dividend yield up on top of this. You know, very quickly this can be a sneaky winner. And, you know, people look at Card Factory and they go, you know what, I don't want to own Card Factory because, you know what, in the last year the stock has only done you know, it's only up 4%. And then you zoom out and you go, actually, to be fair though, when you look at the longer term, the stock's up 138% in the last 5 years. And even if you consider that the stock's not done anything since 2023, well, even from that time frame there, if we actually go from the start of 2023, the stock is actually still up 19%. And let's not forget, you know, that's a 6% dividend yield on top. So actually, your stock is now 31%. So for a boring stock, you know, a stock that's not done anything for 2 years, it's still actually up 31%. And the thing with a lot of these stocks here, something like a Card Factory, for example, I'd be looking at Card Factory and going, and it's still historically undervalued. You know, this stock here, for example, on 2025 numbers is trading at 6 times forward earnings. You know, a company of Card Factory's quality, you could argue the case that actually this should be 10, 11, 12 times earnings. And very quickly, you know, these sort of boring stocks that don't do anything or don't have the excitement, they become sneaky winners. And because people give up because they look at the share price in the short term and they go, oh, Card Factory hasn't done anything for a year, 2 years, I'm going to give up on it. And then eventually you come back in the longer term and you go, actually, this has been actually a sneaky good performer. Like the likes of B&M, for example, this has actually been a sneaky, you know, good performer. And then all of a sudden, you know, people are realizing that these, you know, S&P can't keep going on what it's doing. You know, the stocks that, you know, Palantir can't keep doing what it's doing at 481 times earnings. And eventually people realize, well, you know, actually what it feels like when they own that stock and it's down 23%. You know, the likes of Tesla, and Tesla has the whack and it's down 50%. And all of a sudden people go, actually, you know, these exciting stocks, they can also be very painful. But these boring stocks, you know, that you know, slowly chug away in the background, paying you dividends, you start getting that nice little bump in the share price. Actually, these can be pretty good performers. And sometimes I think especially in the last few months, people have kind of got away from that. And, you know, the amount of times that we're making videos and, you know, B&M were getting slated, and I was like, why is it getting slated? Because you're getting a company here that's, you know, a decent, slow winner in the background. And sure, it's having a tough time at the moment, but, you know, you got to look at what this could do. You know, what could this do in the long term? Could this be a sneaky winner in the long term? Are you buying the stock at the historical lower valuation than what it's ever been, a dividend yield that's, you know, higher than what it's ever been at? You know, those are the opportunities you want to look at. And, you know, it can be a bit boring in the short term. You know, it might not have all the excitement of these stocks, but I tell you, some of these stocks can be, you know, some of these boring stocks can be just as good performers as, you know, these stocks, and they can bring you nice sneaky returns in the background. You know, when you look at the likes of Warren Buffett and Peter Lynch, you know, these guys weren't, you know, making money from buying the stocks that were going to crazy valuations, the next hype stocks, the future big growth stocks out there. You know, these guys, some of these, you know, when you look at some of the investments that these guys were making, they were pretty boring stocks. They were your average stocks that you go in every day and you shop, and you know, you see like actually these are still really popular, but yet the stock price isn't reflecting the fundamentals. People that, you know, they were going into these things, you know, these companies and going, they're all doing really well, but yet the stock price isn't reflecting the fundamentals, and eventually they realised that would catch up, and they made success from it. And sometimes these can be the sneaky best performers to own, and so many people judge a company off the short-term performance of these stocks, and yet they can come sneaky winners, and that's already the case with something like Card Factory. Now, don't get me wrong, maybe a little short-term, but my case would be that in the long term, I think this will be even stronger. That these stocks are up more. You know, Card Factory at the moment, I think I'm up 14% on. You add your dividends on top, I'm over 20% up on Card Factory at the moment for what has been a boring time for it. You know, when I look at B&M, for example, you know, everyone slated B&M and, you know, at the price, but I'm up on B&M. You know, I'm up 6-7% on B&M. You had a 10% dividend yield on top. I'm up over 16% on B&M right now. And all of a sudden, you know, these stocks come really nice winners. And you look at someone like the S&P 500, you know, what's the S&P 500 done in the last year? It's up 2%. It's up 2%. So when you start looking at someone like Card Factory, that was a few months ago a position that was negative for me, and now it's up nearly over 20% at the moment. B&M was a stock that I was down 18% on a few months ago, and now it's a stock up over 10% on right now, over like 16% up on that position right now. Very quickly, these boring stocks can be sneaky winners, and especially in times where we're going through, that comes more obvious, and more obvious as well when you also receive those nice dividends as well. You're like, well, now these boring stocks are actually giving me money that I can go and buy some of these stocks that are getting absolutely walloped. And you know, a nice diversified portfolio, and sometimes that's the boring stocks, can be sneaky winners, and don't forget about them. And I wanted to make that video today, just that maybe it's a little bit early considering, like, yeah, the stocks are up and they're not exactly up huge. Maybe a little bit early for like a victory lap, but certainly like these stocks are bounced. And I remember only a few months ago, you know, a few people were writing these stocks off. You know, why do you want to buy UK stocks? I remember a lot of people saying, a lot of people said, why are you buying UK stocks? Doesn't matter what's happening with the economy, guys. The stock market's not economy. Sometimes some of these stock prices that were going on in the last few months are good opportunities to buy. And if you were buying those opportunities right now, I'm sure some of those are starting to turn a little green for you. And as well as that, you probably see those nice little dividends coming in as well in the next few months as well. So yeah, thought I'd shout that one out. So hope you enjoyed the video anyway, guys. See you in a bit.